Okay, guys, we're going to go ahead and get started. We've got pretty aggressive agenda today because we want to get through the Chapter 8 discussion of depreciation, and then we're going to have to do the little few of the practice questions from Chapter 8, the quiz for Chapter 8, and then we want to have a little bit of time to go through the practice midterm that I posted up on Canvas today, chapters 4, 5, 7, 8, right? And most of our emphasis will be on those first, three chapters, 4, 5, 7, because we'll be talking about Chapter 8 here today, so there won't be much need for us to review that stuff again, okay? Midterm is on Monday, okay? And so please make sure that you are signing in under today's date. Thank you. I suspect that we're going to have some strangers show up on Monday, and if there is any shortage in seats, I don't think there is, but if there is, people that have been attending are going to get first priority. People that have been missing classes are going to have to wait till everyone else sits down. But I don't think we had a shortage of seats last time, but that's how we'll handle any potential shortages. Huh? Yeah, maybe. Yeah, I forget, but we'll figure it out. Everyone who's here will get seated, though. Here's who's here today. Okay? All right, so let's go ahead and start to talk about long-term assets, our fixed assets that we report on our balance sheet. Now, we've been talking a little bit about the classified balance sheet, and we showed both our current assets versus our long-term assets, our property, plant, and equipment, right? Current assets we know are cash, inventory, accounts receivable are all good examples of current assets, right? When we talk about our non-current assets, those are those that have benefit that will probably go beyond the current year. Okay, so when we have an asset in which the benefit will go beyond the current year, we treat that as a long-term asset. So because we have equipment, and maybe we're going to hold that equipment for 5, 6, 7, 8, 10 years, whatever, we report that as a long-term asset, right? Building obviously has a longer life than just 1 year. Land obviously has a longer life than just 1 year. So we capitalize those items on our balance sheet, carry them as non-current assets. Now you're sitting there and saying, okay, well, why do you have this picture of this train up here, if you could figure out that that was a train? Prior to the building of the railroads in the United States, every time a company spent money, regardless of what it was for, they just treated it as an expense. And then when they started building the railroads, there was this issue that these companies were just hemorrhaging all this cash to build the railroad. Nobody wanted to invest in them, so they came up with the idea of, well, then we'll go ahead and we'll capitalize the money we're spending on the balance sheet, and that way people will realize that we're building this significant asset that has future economic benefit that extended, for years and years as the railroads, grew and helped, help build the country, depending on who was getting rolled over in that process. But
when did they capitalize?
the value of the track that they were laying, the trains that they were buying, etc.
Steel or just all of it?
The equipment that they were building. They were building a railroad. So as they built the railroad, if you read that detail, as they built the railroad, they debited construction work in progress as they were building it, and they would have credited, whatever their raw materials were, whatever their labor costs were, whatever their overhead was that was being applied to that process. They would go ahead and credit that. They would debit construction in progress, and then when the thing was finally done, they would debit fixed asset. And they would credit the construction work in progress because that's now done. Okay? So eventually what we end up, and my point was that we end up with a fixed asset being reported on the balance sheet, right? Okay, I'm not holding you accountable. as to how fixed assets get there in a construction type situation, but since you asked, that's how it would be done. Okay? Now, once we put a fixed asset on our financial statements, now we need to go ahead and we need to depreciate that fixed asset. And we talked about that somewhat in some of the earlier chapters, in that what? We will have to depreciate equipment, buildings, etc. Land is not depreciated, right? And we've said, sometimes, well, maybe the land falls off the edge of the mountain or something, but at that point we would just take that loss at the time it falls off, right? But for the most part, we will not depreciate land. For our other fixed assets, yes, we will be depreciating those, okay? So we come over, and when we think about depreciation, there are some key factors we're going to need to know. One is the original cost of the item. That's what we pay for it. The other is the useful life. How long will this asset be in use? The other is the salvage value for this asset. In other words, once we're done completely using this, what do we think we could still sell it for? So when someone comes to buy this hunk of junk, after we're all done tearing it up, what would they be willing to pay for a truck that we purchase? Okay? So we have those factors now up in this example where we buy a delivery truck, we pay $13,000 for it. Now when we buy the delivery truck, we of course do what? We debit our equipment and we credit our cash, right? Then what? Then we need to know what the expected salvage value of this. In this case, it's $1,000. The estimated useful life in this example is 5 years. And they also give us the estimated useful life in miles. And the reason they're doing that is that I'm going to sit here and I'm going to talk about a couple of different methods here, really 3 different methods that we'll talk about. One is straight line, and if we're talking about straight line, we'll be needing to use the useful life in years. The other is units of activity that we'll use to depreciate that. And if I'm using units of activity, I'm going to need the miles that this truck is being driven. If it's a machine and I'm going to be using it for so many hours, I would use the hours, whatever it is. Okay? Declining balance is basically an accelerated version of straight line. So we're still going to be using the years, but we're actually going to accelerate, speed up the process of recording depreciation for this when we use something called declining balance. And one of the most common ones we use is double declining balance. Okay? So we purchase this equipment, we debit equipment, we credit cash, right? The equipment asset is reported on what financial statement? Equipment is not reported on the income statement. Equipment is an asset. Assets are reported on the balance sheet. Assets have future economic life, right? Okay? All right. Now, you come over and we take a look, and there are these different methods. We can see here most companies use straight line. Most companies use straight line because it is the easiest to use. You estimate the life of that asset. You divide the salvageable value by not the salvageable value, the depreciable base by that estimated life, and that gives you depreciation each period. If you try to use units of activity, you're going to have to keep track of other information, which makes this method more difficult. For example, you're going to have to sit there and figure out how many miles you drive this vehicle each year or whatever. And you sit there and say, well, that's not that difficult. Maybe not if you're just talking about one delivery truck, but if you're FedEx and you're talking about fleets of they probably got millions of vehicles and stuff that they use, that can be a pretty monumental task, couldn't it, to keep track of the mileage for all of those trucks. So a lot of entities will just simply use straight line because that's the most straightforward, easiest to use. Okay? Declining balance is used by some companies because it could have a tax benefit that may allow them to decide to use declining balance. Okay, good. So we come over and let's just remind ourselves now as to some of the key aspects of this. We bought the truck for how much? $13,000. Its salvage value is what? $1,000. So we're just going to depreciate the depreciable base to $12,000. We're not going to depreciate that $1,000 because what? we were thinking we're going to recover that money at the end of the life of this asset, or when we're done using it anyway, right? So we don't depreciate that part. We just depreciate this depreciable base. We divide that by 5 years, so our annual depreciation is what? $2,400 a year, and we'll take that each year for these 5 years, right? Okay? So, if you take a look at the way they've calculated that here, you can see that they're taking $12,000 and they're taking 20% a year. Now, I'm not trying to insult anyone's intelligence, but sometimes students say, I don't understand that 20%. I thought you said it was 5 years. Well, 1 divided by 5 is what? 20%. So we're going to take 20% a year, aren't we? Okay? And we take that depreciable base, we multiply it by the 20%, and that gives us our annual depreciation. We take that in year 1, year 2, year 3, year 4, year 5. We take the same amount in each one of the 5 years, and we report that on the income statement as depreciation expense, right? Okay? Now you take a look, and each year we will also credit accumulated depreciation, okay? And we'll keep crediting that accumulated depreciation each year. Goes up $2,400 as we credit the accumulated depreciation each year, debit the depreciation expense on the income statement. Now, over that time, that accumulated depreciation builds up, doesn't it? Okay, so when you take your $13,000 minus your accumulated depreciation at any point in time, we call that difference book value. And so for year 1, $13,000 minus the what? $2,400 gives me a book value of $10,600, right? Year 2, $13,000 minus what? $4,800 gives me $8,200, and so on, right? Notice at the end of year 5, what's the book value? $1,000. How much do I think I could sell it for? $1,000. So the financial statement is showing exactly what I think I should be able to sell this asset for at the end of year 5, right? Okay. So this is straight line depreciation, and you come over, and what this little thing is trying to show you is how we do what? Each year on the income statement, we take $2,400 depreciation, don't we? Right? Debit the depreciation expense. And then each year, we credit accumulated depreciation, don't we? So year 1, we credited accumulated depreciation. So we would only have what? This $2,400 for the first year showing in the accumulated depreciation. And if I would prepare the balance sheet at the end of year 1, equipment is $13,000 on the balance sheet minus my 1 year's worth of accumulated depreciation. Net value of the equipment net of depreciation is what? $10,600. That's my carrying value, right? Okay. Year 2, what do? Debit depreciation expense, credit the accumulated depreciation, $2,400. Depreciation expense in year 2 is $2,400 every year, right? We close out our expenses to 0 each year, don't we? Start over. So my depreciation expense is $2,400 for year 2. I credit the accumulated depreciation. Now there's $4,800 in there, isn't there? So when I prepare my balance sheet, I haven't touched the equipment account. Remember, I keep saying, don't get creative. Don't start telling me how equipment has a lesser amount. Equipment had $13,000 in there, didn't there? Didn't it when I purchased it? And now my accumulated depreciation is $4,800, so the carrying value is $8,200. Just like we were looking at that chart a minute ago, I'm just showing you how that would be reflected on the financial statements each year, right? Year 3, debit depreciation expense, $2,400 on the income statement. Now my accumulated depreciation has been credited 3 times for $2,400. That's $7,200. Carrying value of the asset is what? $5,800, right? And so on. I'm not going to go through every single year here, but the depreciation expense is $2,400 a year. The accumulated depreciation builds up by the amount that I have debited the depreciation expense, credit accumulated depreciation for each year, right? By the end of that 5th year, I have what? I have my equipment showing net of depreciation of $1,000, which is exactly what I think I could sell it for, right? Question? Okay, good. So you come over then, and I make the point here that depreciation is an estimate. we don't know exactly how much we're going to sell this asset for, right? So we're just coming up with our best estimate. I mean, we don't know that it's going to be worth $1,000 at the end. We don't know that it's going to last 5 years. We just come up with an estimate, don't we? Okay? So, I tell you here that companies are required to provide disclosure in their financial statements that warn the users of the estimates that are in the financial statements. That what? Things in the mirror may be closer than they appear. That little word you see on the side view mirror of a vehicle is also a warning about estimates, isn't it? So don't pull too quickly into the lane, right? You want to take another look at that, whatever, right? Well, same thing with depreciation and other estimates, frankly, that are in the financial statements. GAAP requires, FASB requires that companies put that warning in the financial statements so people don't sit there and say, well, they're going to definitely sell that thing for $1,000. We could sell it for more, we could sell it for less, right? Because we really don't know how quickly it depreciated, right? We just took our best estimate, okay? So, when we go and we sell the item, if our estimate was perfect and we sell it for $1,000, we'll debit cash for $1,000. We'll do what? Debit the accumulated depreciation for $12,000 to get it off the books, right? Because we're getting rid of the truck. And we'll credit the truck for $13,000. No gain or loss is recognized because we sold the truck exactly for its carrying value, right? Okay? Now, what happens if our estimate was a little bit off? We sell the truck for $2,000. Well, now we sold it for more than we thought its value was. No problem. Everyone knows that was just an estimate. We warned them about that each year, right? So what do? At this point, we just go ahead, debit the cash for $2,000, debit the accumulated depreciation for $12,000 because we're getting rid of that, credit the equipment for $13,000 to get rid of the equipment, and go ahead and credit the gain for $1,000. I find it hard to believe that there's still people insisting on texting and playing other things while I'm trying to teach the class, and I'm telling you guys, it's a waste of your time to come here and do that. I don't understand it. I would stand out in the street with my shoes off before I come into a class and sit there and do all kinds of other things. You might as well go and blow the gutter water or something. Anything is better than sitting in here and then trying to do something else. Okay? Alright, so what happens? Since I have sold this asset for what? For more than its carrying value, I have a gain, don't I? I have a gain of $1,000. Now, if I sell the asset for less than its carrying value, say I sell it for $500, who wants to try that journal entry? We'll start out with the easy one. I sold the truck for $500 cash. Okay, good. You're right. I'm just helping you to put the entry together. Debit cash, right? $500. Now what? Debit the accumulated depreciation for what? $12,000. Okay, good. Got to get rid of the equipment then, don't I? So I should credit the equipment for $13,000. I'm getting rid of the equipment. I'm selling the equipment, so I have to credit it for $13,000, right? It's an asset. I'm trying to decrease the asset to get rid of it, so I have to credit it, right? So I need what? $500 debit to make this journal entry balance? Mm-hmm. So you're saying you want to debit the loss here for $500, right? Okay, because I sold it for less than its book value, its carrying value. Okay, good. Okay, so these are estimates that we take for our depreciation. If they're a little off, don't worry about it. By the time we go and sell that asset, we can, what did I say? We can save the world with journal entries, can't we? Yes, we can. Okay, so at the end, if there's something that isn't working out exactly the way we planned it, then I'm just going to go ahead and I'm going to make an adjusting entry at the end of the year to get this thing to balance out, right? Okay? Okay, good. So let's go ahead then and let's take a look at the next depreciation method here that we're going to deal with. Okay? So we need to be in accounting business 20 material during class. Okay? So if we're not going to be able to do that, it's better off to try to do it with someone else. Maybe they got an English class or something. Okay, you got your slide here? Okay, good. Okay. Looks like, what, chapter 7, we're chapter 8, right? Yeah, we're chapter 8. Okay? Oops, sorry. Okay, so let's go ahead and let's, yes sir.
Will you update the slides on Canvas with these ones?
These are the same things, they're just a couple of things. The railroad thing is different, etc. It's the same
Yeah,
thing.
there's a couple ads.
Yeah, but there's nothing significant. It's just the
Are
railroad.
we not going over plant assets then?
It's not. What you have on Canvas is fine.
So loss would be under the expense category, right?
Good. That's a good question. No, expense is normal course of business. Okay, so it is on the income statement, but it's not a normal course of business, so it's going to be reported as a non-operating item, right? Selling the equipment is not a normal course of business item, so the loss is treated is down there in non-operating.
So it would just be listed as
Yes. Yeah, we looked at that before when we looked at the multiple step income statement. We had revenues minus expenses were operating. Then we started having non-operating items, and included in there were gains and losses on the sale of equipment, right? Okay? Okay. All right, good. So let's go ahead then and let's take a look at units of activity. Now, units of activity is a pretty smart way of doing our depreciation. Because remember, we had said in the introduction for this particular item that we were going to sit here and we were going to drive this truck for 100,000 miles, right? So since we were going to drive the truck for 100,000 miles, that came out to what? 12 cents per mile that we were going to be using we use this truck. It's 12 cents per mile. So once we know that it's 12 cents per mile as we use the truck, if we drive the truck 15,000 miles, then our depreciation for that first year is going to be what? 1,800, right? So now, as we look at our depreciation expense each period, we do what? For the first year, we drove it 15,000. That's 1,800 of depreciation expense. We debit depreciation expense 1,800. We credit the accumulated depreciation 1,800. We will report depreciation expense on the income statement. We'll report the accumulated depreciation on the balance sheet, and instead of it being the same amount every year, it'll vary depending on how much we drive the truck, right? Okay? If we drive the truck a little bit more that next year, double essentially, then what? Then we're going to take more depreciation, aren't we? Okay, so the more you drive or the less you drive the truck, the more or less your depreciation is each period, right? This is a pretty smart way to take the depreciation. If I don't drive the truck at all, how much depreciation should I take? Don't take any if you don't drive it. Although, if you read, deeply into standards and stuff, they'll say, well, you should always take some base amount of depreciation because what? If the truck just sits there for what? For 100 years, there'll be dust eventually, won't there? Okay, so they usually say, well, you should take some base amount. But for our purposes, what? If you don't drive the truck, don't take any depreciation, right? Okay? Now, this is a pretty smart way to do this, and you think to yourself, geez, this is what every company should do. Keep track of how much you use the thing and base your depreciation on use, right? But what? We're going to have a separate record-keeping process that's going to do what? Keep track of the miles driven, and if we have a huge fleet of vehicles, that's going to be a little tough for us to every year have to read the odometer of every single truck from the beginning of the year, end of the year, calculate the difference, etc., right? But I would imagine over time that could get easier. I'm thinking maybe a company like FedEx or something maybe has wireless odometers these days that feed into some app or something that accumulates the miles as the truck is driven, whatever, right? Okay. Okay, so that's basically our units of activity method, okay? Now, we can also have something called declining balance. Declining balance is an accelerated method of depreciation, and the most typical type of declining balance is double. Okay, now it doesn't have to be double, could be triple, could be 1.5 times declining balance. But what we do is we essentially take the straight line, and then if we're using double, we Double the straight line. Okay, if we're using triple declining balance, we do what? Triple the straight line. Okay, so what happened? Remember we said in our little example here was a 5-year truck. 1 divided by 5 is 20%. Double 20% is what? 40%. So I'll take 40% as my depreciation each period, right? Pretty easy. Okay, the only couple of important differences. One, notice here, guys, we did not use the salvage value in our calculations. We did not use the salvage value in our calculations, right? Why are we having the test on Monday? I'm trying to think. Is there a reason that we're taking it on Monday?
That's why that goes on Wednesday.
That I can answer. Because I don't want the head of the department to fire me. That's one of the reasons. Oh, yeah, right. Yeah, that'll last long. They'll say, John, how come the entire school wants to take your class next semester? We know it's not your charming personality. Okay, so I'm thinking about this.
Do people ask you questions about how many chapters you've taught over the semester? Or does that matter somehow?
No, they leave that to my judgment to figure out what needs to be taught. I mean, I'm not objective in my opinion. I think I come with a fairly good understanding of what needs to be taught in the introductory to financial class, because I then also teach the accounting majors. The next class up, I teach the managerial accounting, not here, but at other schools. So I know what you need to know for managerial accounting, and then I teach the students that come in as accounting majors into the governmental accounting class, and then I've been teaching a CPA exam for 20 years. So I know where people are going with this material. You're either going to go into a business program and never look at it again. You're going to be an accountant, and then you're going to have to use it at that next level, and then eventually you're going to have to use it to pass the CPA exam. So I choose the chapters that I cover based on that understanding, and I think that the university looks at my background and resume, and that comes as part of the package, and I understand that. But I can't not test you. So...
Today would be more prudent to go through chapter 8, its fullness today, do a review on Monday, and do the test next Wednesday.
Right? I don't know about more fullness, but at least we don't have to sit here and feel like we're rushing off the edge of a mountain. So... Right, you have that practice midterm, so now everyone's going to start taking breaks. Oh, cool, we're not going to take the test until Monday. So you want to, not on Monday, so you have that practice midterm up there. You review that, we go over it together again on Monday, and then we take the test on Wednesday, right? Yeah, that makes more sense. Yeah. No, it just kind of hit me all of a sudden as I'm just trying to think, okay. I mean, we lose Wednesday as a study day towards the next chapter is the bad that, I mean, the next to the finals, the bad that goes with that. We'll cross that bridge when we come to it. I think that's going to be better. Okay? Okay, so test is now on what day, guys?
Wednesday.
Wednesday, a week from today, and I'll put that announcement up on Canvas, and frankly, people are checking out of class.
Come on Monday.
Huh?
Don't tell Canvas and then have everyone come on Monday, so they can review too. They get their they can teach the review. Yeah, don't tell anyone that doesn't come.
Oh, what are you trying to kill me? I'll be there all weekend. Dear friends, don't expect to hear from me this weekend because I have to email everybody in my class. Who am I going to send that to? My stuffed animals. So anyway,
You should show up with like a fake test on Monday, just to mess with the people that think the test is still on Monday.
I thought I was cruel. You guys okay. All right, so we'll do it on Wednesday, and I won't send anything out on Canvas on that. So that then people show up, right, and they're here for that discussion, right? Okay. Deal. Okay, so we'll do it on Wednesday, not Monday. There won't be any announcement on Canvas, right? Nothing on Canvas, so, okay? Okay, all right, good. So what happens? If we're going to do double the straight line, instead of doing the 20% to the straight line, we're going to double that. We're going to do what? 40%, right? Okay. Now you take a look, and an important aspect of double declining balance, as I was saying, is even though we still know what our salvage value is, we don't use it in the calculation. Do you see that? We don't use it, because remember the salvage value was 1,000. We're going to depreciate off of the full cost of that equipment, the $13,000, right, to calculate our depreciation each period. Now that doesn't mean that we ignore the straight line, the salvage value. We put it off to the side and we eye it as we're taking our declining balance, and we will not depreciate below the salvage value. So the salvage value is going to really be a what? A floor of which we will not depreciate below. So we consider it, but we don't use it in the calculations. Okay? So just take a look at this chart here, and when we do our declining balance, again, we don't use the salvage value, right? We just take the straight 13,000, we multiply that by 0.4, or 40%. That's double the straight line, right? Straight line was 20, double the straight line is 40. That gives me $5,200 of depreciation for that first year, right? Okay? So now what happens? My accumulated depreciation now has $5,200 in it for that first year, right?
Yep.
Debited depreciation expense, $5,200, credit the accumulated depreciation. So now the what? The $13,000 minus the accumulated depreciation at $7,800 gives me accumulated depreciation of what? $5,200 gives me a new carrying value, $7,800. See how I got that?
Yeah.
13,000 minus the accumulated depreciation of 5,200 gives me 7,800. I take that 7,800 and I bring it down, and that's my new carrying value, isn't it? I multiply that by 40%. That's the double declining depreciation percentage. That's my depreciation for year 2, isn't it? 3120. Okay, I go ahead and I take that now, and my accumulated depreciation is 5,200 plus 3120. It's 8,320 now, right? See where I got the 8,320? 52 plus the 3120, 8,320, because I've debited depreciation expense. I credit accumulated depreciation for that next amount, right?
Yeah.
Okay? Okay, good. So that now gives me what? 7,800, the previous carrying value, versus the depreciation now for year 3 gives me a new carrying value of what? 4680. I bring that 4680 over. 4680 times what? Times 40% gives my depreciation expense for year 3. I think I've mislabeled this up here. This should be, yeah, this is my year 3 depreciation, right? No, that's my year 2 depreciation. What am I doing? 7,800, that's year 2. No, that's right. Year 3 now, I was just here, did this, now I'm to year 3, right? I bring forward the what? The 4680. 4680 times what? 40% gives me the depreciation. That gives me my accumulated depreciation, 10,192. Book value of the asset is what? 2,808. I bring that forward to year 4. Year 4 depreciation, 40% of that. That gives me my depreciation for year 4. That brings my accumulated depreciation up to 11,315. That now 13,000 minus 11,315 gives me carrying value of what? 1,685. I bring that new carrying value over. I multiply that times 40%, don't I? Now when I take that 1,685 and I multiply that times 40%, what do I get? Huh? 674?
Yeah.
Okay, good. So if I take 674 off, then that means that the new carrying value is what? 1011, you say? 1011? Like that? Well, whoever said 1011, why would you wonder if I say if it's 1011 like that? It's 1011, isn't it? Okay. So that 1011, right, is now $11 away from being the $1,000 floor, right? Now, what the book said is, look, we're not going to bother with a year 6 in which we take how much of depreciation? $11 is the, if we took 40%, it'd be what, like 400 something. We can't take 400 something. We've got to take what? Just $11, so they just rounded. But for teaching purposes, they should have gone ahead and shown a year 6, and then what, just took the $11? And you would have stopped right there, or came up with an example which there was enough that was worth their trouble to worry about in that last year, so that they wouldn't depreciate below salvage value. But the takeaway is what? You stop at the 1,000, right? Even if you have to take 2 cents that last year or whatever, you stop. Yes, sir.
So if you do take the 60, wouldn't it drop below 1,000?
I only take $11. When I do year 6, 1,011 times 0.4 would be what? 404? 404? 404? Okay, well I can't do that. I'm not allowed to take 404 because that'll bring it down to 6 something, right? So I just take $11. So I just take $11, right? I guess I could go. Did they let me do the last slide? No. So I just take $11 and I stop.
Is that different than the next slide where it's the partial year?
Yes, it is. Each year we took 5 years. We took the full year each year. The next slide is going to get into what happens if I purchase this equipment in the middle of the year. Okay? So this one was taking a full year each year, and the story is, the takeaway is, you don't use the salvage value in the calculation, but you do not depreciate below salvage value, right? You stop at the salvage value. Well, the benefit of taxes, although it's not exactly double declining balance, the federal government, IRS, and I think the state of California as well, but let's just talk federal, will allow for accelerated depreciation. They call it MACRS, something accelerated depreciation or something. I forget what MACRS stands for. But under the MACRS, makers, some people call it makers. I leave that reserved for whiskey. But when they call it MACRS, what they do there is they let them take an accelerated depreciation so they get a bigger tax deduction. Why is Congress interested in doing that? Why is Congress interested in letting people accelerate their depreciation so they get a bigger tax deduction? The corp help them stay? Oh, that's a big lie. That idea that somehow beneficial tax laws will make corporations stay in the U.S. and not go overseas, that's just a lie that's told. Where are they going to go? Okay. Huh? Yeah, right. I mean, I guess they can move their plants to Mexico or something like that, but really, it's not the tax incentive that's there, it's the cheap labor that drives that, okay? So they always say that, but that's not true. The idea is that if I let you take depreciation on your equipment, and I let you accelerate that depreciation, then you're going to be more motivated to do what? To buy more equipment, right? And if you buy more equipment, then I'm going to buy more equipment from your factory, and you're going to hire more people, and that has what they call, you've probably heard of the multiplier effect, okay, in economics, and the accelerator effect. And so that investment accelerates then spending, et cetera, and that helps grow the economy. So that's the main reason that they allow for this faster depreciation. Okay? But that's how it helps with tax. Yes, a question?
So how is it fast? Trying to word it right. Like faster depreciation if they both take 5 years to depreciate fully. So we're trying to do that. Like with this declining, so it takes 5 years. You don't pass that 1,000 mark. And with the straight line, it's still.
Well, it's faster in the beginning and it's slower in the end.
Okay. So the theory is that because it's depreciated so quickly, you get a new one before it's finished.
Time value of money kicks in. Okay, when you take the finance class and you're deciding capital budgeting issues, okay, and you have what? You have the depreciation, and the depreciation shields certain amounts of income from tax. Well, that increases the cash flow, and if that cash flow is more in the earlier years, that makes the net present value of that investment bigger, and it's more likely that you're going to decide to go ahead and buy that piece of equipment, right? And so that's why it helps to take the depreciation faster. When I say faster, that's a good point. Faster in the earlier years, it's slower in the later years, right? As we have a smaller balance that we're applying that 40% to. Okay? Okay, so we do not depreciate below salvage value. Yes, that's correct. Okay? Now you come over. Yeah, where is that next slide? Okay, well I don't care about it. We don't need the next slide. Okay? What I want to show you is this. Let's say, and what that next slide was supposedly going to show you, and I don't think they do a very good job on it. I think that's why I deleted it. Let's say that I purchased this property $13,000. I purchased this equipment for $13,000. Is there a reason why every time I'm teaching the class you stop and then you ask the person next to you the question? So that now he can't hear what I'm saying? Is there a reason for that? Do you have a question?
Oh yeah, I'm just kind of confusing.
1011 is 1685, which was the previous carrying value, minus the depreciation when we applied the 40% to the 1685. That was 674. And somebody told me that 1685 minus 674 equals 1011. Right? Does it equal 1011? Okay, so you take that 1011 and that becomes the carrying value for that next year, right? Okay, and then you take the 1011 and you apply the 40% for that, and we said, well, that gives us 404, but we can't take 404, right? Because if we take 404, that'll bring us down to, what, 6 something? And we can't do that, and so would it take us to 607 or something? Because that would have us depreciate below salvage value, right? Okay, so we just take $11 depreciation that last year, and when we do, now the carrying value is going to be what? Maybe that's what you were asking. Now it should be 1,000, right? After we just take that $11. Okay? Don't be afraid to ask me a question, okay? And I'll answer it. And that way, what's your name, sir? Trevor can listen to this next part, okay? Yes, sir.
So when you were talking about the box on the top right, and it says year 2 depreciation, wouldn't that be the year 1 depreciation?
No, it's year 2. Because it was 7,800 was the year one, right? And then we took that year one new carrying value and we brought that over to year two, right?
So the depreciation that occurred in year one was 5,200.
That's correct. 5,200 minus 13,000, right, gives me 13,000 minus 1 year's worth of depreciation, right, gives me 7,800.
And so then the journal entry for year one is below the table?
Yes, journal entry for year one is right there. Debit the depreciation expense, credit the accumulated depreciation, right? Okay. Now what? Now my year two accumulated depreciation is 8,230 because I did what? I brought forward the ending carrying value for year one, 7,800 times what? Times 40% gave me 3,120 of depreciation for that next year, right? Okay, and so now my accumulated depreciation is that 8,320. That's the 5,200 from year one, the 3,120 from year two, right? Yeah.
So for a year, if you were to say year one depreciation would only be just the depreciation year, but you're just writing the equations up there in the box for adding it to year two.
I'm showing you this up here to show that if I took 7,800 now, which was the amount I originally purchased it for, minus my year one depreciation, gives me 7,800. That's where that 7,800 came from, times the 40%, gives me 3,120 depreciation for year two, right? Right? Okay, then the new carrying value is what? Is going to be this 4,680, right? How did I get the 4,680? The previous year's carrying value minus 3,120 gives me the 4,680, right? Or I could have said 13,000 minus the 8,320 cumulative depreciation is going to be the same thing. I'm just sort of showing you the shortcut up here in this black and white. Okay, and then that gives me the new carrying value at the start of year three. I multiply that times 40%. That gives me the depreciation for year three. I guess I should have wrote it in here. Is what? 1,872. Okay, and then I could say, okay, 4,680 minus what? Minus now this 1,872 gives me 2,808, and then I'm going to multiply that for year four times 40% and so on. Okay? Okay, and I don't depreciate below salvage value. Okay, now we come over, and we don't have that next slide, but I'm going to just do it right here. Let's say I purchased this equipment for $13,000, and I'm going to take double declining balance as 40%, right? But let's say I buy the equipment on October 1st. If I buy the equipment on October 1st, did I really hold that equipment for a full year? I held it for what? All of October, all of November, all of December. I only held it for 3 months, right? So to get the depreciation for that first, not even full year, the first 3 months of ownership, but if it's December 31st and I want to calculate my depreciation, I'd multiply that by 3/12, wouldn't I? And that would give me what? 13,000 times 0.4 times 3/12? Huh? 1,300? 13,000 times 0.4 equals 5,200 times 3 divided by what? 12, 1,300? Okay, great, thank you, sir. Okay, not that I didn't trust you. Somehow it wasn't ringing a bell for me that it would be 1,300, but that's fine. So 1,300 is the depreciation here for year one, isn't it? Right? Yeah. So if I'm using declining balance, what am I supposed to do with that 1,300? good. I subtracted from the previous year's carrying value of 1,300, right? That gives me a carrying value for year 2 of 11,700. Okay, and so now 11,700, now I'm going to hold that equipment for the full year, right? So for that next year, I multiply that by what? My 40%, my double declining, so my depreciation for year 2 is going to be what? 4,680. I'll subtract that off the 11,700. That'll be my new base. I'll go into year 3 like that, right? And then assuming that, you know, I get rid of that equipment in the middle of the next year or middle of the last year, assuming it has to only last 5 years, then I would only take 9 months in that last year. If I indeed had to, you know, man, look at, I'm a genius. I said it was going to last 5 years, and it lasts exactly 5 years. If it goes fully into that next year, then I could go ahead and take the full year's depreciation, as long as I don't depreciate what? Below salvage value. I cannot depreciate below salvage value.
So what happens if you use the equipment below the salvage value? You just don't take any depreciation?
I just don't take any depreciation, and we have, you know, 5, you know, we drive it for another 2 years. So we have 2 years in which we don't take depreciation, right? So now the message in the mirror should read, objects in the mirror are further away than they appear, right? Because we thought it was going to be 5 years. Could be closer, could be further away, right? It's okay. We call that change in accounting estimate. And if that's the case, you don't take depreciation for a couple years, and then when you finally sell that thing, if you sell it now for what? Let's say you sold it for less than the carrying amount, because now it's gotten a little junkier during that 2 years, hasn't it? So what's going to happen? Well, we'll take a loss when we sell it. If you think about it, that's a catch-up for those other years in which we didn't take any depreciation. But we don't go back and, you know, say, well, this is to account for those earlier years and all that. That would get way too messy for us to try to do that, because pieces of equipment just refuse to adhere to our estimates. And so we'd have to be constantly explaining, well, we're going back and we're fixing because this. After a while, the user of the financial statements would say, just keep them, okay, since you're always changing your mind. And so we just keep going forward, doing our best to have the best estimate we can on this. Okay? Okay, good. Question? Okay, good. So that leaves us, what, we got about a half hour left? That leaves us 20 minutes to go ahead and take a look at the quiz from Chapter 8 then. And I think when you look at the quiz questions, guys, if you're kind of sitting there saying, oh man, do I have this? You'll see that this is actually pretty easy for us. Okay? So, quizzes, I believe. Sort by date, modify, Chapter 8 quiz. Okay. That Chapter 8 though. Now you guys will work this next semester. You'll know what standard costs are next semester, but not this semester. Huh? You what? For 10 seconds while the answer is up there? Okay. Okay, so what happened? So we're looking at this, and this is on Canvas, okay? And we say the company purchased office equipment for $40,000. Estimated salvage value is $8,000 at the end of its at the end of its 4-year useful life. The constant percentage is to be applied against book value each year. If double declining balance method is used, well, look, straight line is 1 divided by 4, right? Right? Okay, everybody sees where I got the 1 divided by 4, I hope, right? Okay, and so then what? That's 25%, and if I double that, that's 50% for double declining balance, right? Okay, okay, good. Let's take a look at number 2. Company purchased a piece of factory equipment for $350,000. It is estimated the equipment will have a $35,000 salvage value at the end of its estimated 5-year life. If the company uses double declining balance method of depreciation, the amount of annual depreciation recorded, and they're going to make us go into the 2nd year on this one, right? Okay, so our first job is, well, what's the straight line? 5-year life. 1 divided by 5 is what? 20% times 2 means I'm going to take what? 40% a year, right? So that first year, and I don't worry about the salvage value in my calculations, right? 350,000 times 40% means I'm going to take 140 the first year, right? Right? This is like those little black and white boxes up there in the corner now, the way I'm showing you this, right? Okay? Then what? Then I go ahead and I take that 350,000 minus the 140. That gives me a carrying value at the start of year 2 of 210. 40% of that means that my depreciation is going to be 84,000 for year 2, right? Okay? Okay, good. Come over. Let's take a look at this one. A factory machine was purchased for $125,000. It was estimated that it would have a salvage value of $25,000 at the end of its 5-year life. It was also estimated the machine could run 40,000 hours in the 5 years. The company ran the machine for 4,000 hours. If the company uses the units of activity, so even though I gave you the life on this thing, we're not going to use it for these calculations. We're going to use the units of activity, right? So we still, though, for units of activity, just like straight line, we only depreciate the depreciable base here, right? We don't depreciate salvage value. So we take that 125,000 minus the 100,000. 100,000 divided by what? By the 40,000 hours. That's $2.50 per hour. And if we use the machine for what? For 4,000 hours, then we're going to multiply the $2.50 per hour times the 4,000 hours. That means my depreciation expense is what? 10,000, right? Okay. I think what I did here is when I taught this class the other day, I asked this lesson the other day. I asked, what if we drove the machine, used the machine 5,000 hours, right? Then it's going to be what? 250 times the 5,000 that next year whenever we drive it, use it, 5,000. I keep saying driving, but it's probably using the machine. If it was driving, it'd be miles probably, right? Okay? Okay, good. How about this next one? On October 1st, 2014, Polk Company places an asset into service. The cost of the asset is $80,000. Estimated useful life is 5 years, and the salvage value is $20,000. What is the depreciation expense if we use straight line? Now, straight line is so easy. Come on now. 80,000 minus the 20,000 gives my depreciable base of what? 60,000, and that's a 5-year life, right? And it would be 12,000 for what? For the whole year. And notice how they put that up as choice A. That is not a mistake. They're trying to bait you into getting hasty, thinking you got an easy question, quickly calculating that, and notice this idea of October 1st is when they put that asset into service was the first thing, and you had already read past and probably forgot that under the stress of taking a test, right? Huh? Yeah, you know, and you're in a hurry and you're worried and whatever, right? So, what happens? After, for straight line depreciation questions, the way you avoid that mistake, after you have selected your answer, go back to the question and confirm when that asset was put into use. And count on your fingers. All of October, all of November, all of December. If you take 2 seconds to do that, you're going to avoid a mistake, and later on you're going to be going, but I had it. Okay? Okay, good. Come over now, and we take a look at this next one. company purchased factory equipment on April 1st for $80,000. It's estimated that the equipment will have a $10,000 salvage value at the end of its 10-year useful life using straight line. Same thing, right? Okay, 80,000 minus 10,000 is 70,000, and then we divide that by 10, that's 7,000 a year. But since we put that asset into use April 1st, all of April, all of May, all of June, all of July, all of August, all of September, all of October, all of November, all of December, that's 9 months. See how long that takes you? It takes you all in 9 seconds to make sure you got the right amount of months, right? Okay? Okay, good. Come over. October 1st. Is that same question? Number 7? No, we're on 6, right? Okay, October 1st, whole company pays this asset into service. The cost of the asset is $80,000. Useful life is 5 years, $20,000 salvage value at the end of the useful life. What is, okay, this one, instead of asking me the depreciation, they're asking me what? What is the book value? What is left on this thing, right? Okay, so this is a little different. Again, double declining balance, double the straight line. 5-year life is 20% for straight line. Double that is 40%, right? Okay, so I go ahead and I take 40% of 80,000 for that first year is what? 32,000 times how many months? October, November, December, 3/12, right? Okay, so I take 8,000 that first year, right? Okay, so I've taken 8,000 the first year, and then what? Then I go ahead and I take the 72,000 that's left. For year 2, 72,000 times 40% is going to be what? 28,800, right? And then that's leaves me now 43,200 for that next year. Okay, but the problem didn't ask all that, so I'm not sure why I kept going with that. They just wanted what? They just wanted the first year's carrying value, which was that first year's depreciation off of the 80,000, right? I guess I was just showing how to keep going with that. Okay, straight line is the most frequently used, right? Okay, how about this one? A company sells a plant asset which originally cost $240,000 for $80,000 on December 31st. The accumulated depreciation account had a $96,000 balance, and the company should recognize what? Now that current year's depreciation of $24,000, that's a distractor. They've taken that depreciation, haven't they? And so now the accumulated depreciation is up to $96,000, right? Okay, so I take what? The $240 original cost minus the accumulated depreciation, $96,000, means I have a book value of $144,000, right? I subtract off the $80,000 cash that they got. That means they got a $64,000 loss, didn't they? Okay, and if you want to put that in the format of a journal entry, I should say debit cash, $80,000. Get the accumulated depreciation off the book by debiting it, $96,000. Credit the equipment, $240, and to make the journal entry balance, I needed this $64,000 loss, didn't I? You could do it by the journal entry as well, or you could just do it by these calculations right here. Okay. Okay, good. Number 9, equipment that costs $210,000, and which there's $100,000 of accumulated depreciation had been recorded. Was disposed of for $90,000 cash. Okay. So what happens? $210 is what I originally paid for the asset. Accumulated depreciation is what? $100,000. So it's got a book value of $110. I sold it for what? $90. So I got a $20,000 loss, don't I? Okay. Now I showed you the journal entry here as well. There's a debit to cash for $90. Debit to the accumulated depreciation for $100,000. Take that off the books. Credit the equipment for what? $210, and we debit the loss for $20, right? So there is no credit to the equipment for 110. It's a credit to the equipment for the full 210, isn't it? And the credit, there is no credit. It's a debit to accumulated depreciation, right? Okay? Question? That's it, right? Okay, well, good thing we decided not to. We would really have trouble going through that practice midterm. Yeah, that would have been a little tough. So, it's up there on Canvas. Look at those questions. Oh. However, maybe I'll come up with some new ones. Hang on here, guys. What is that? Hang on, guys. Chapter 4, 5, 7, 8. 4, 5, 7, 8. Hang on a minute, guys. Do not work questions 12, practice midterm 12, question 12, question 24, 25, and 26. 12, 24, 25, 26. I mean, the people that write these textbooks and people that write these questions, they get themselves locked into this notion that you just take either the percentage of sales or the percentage of the accounts receivable and the two shall never meet. And the reality is that nobody does that way, okay? Most companies will take a provision during the year as a percentage of sales. And they do that because they're going to prepare quarterly financial statements and they want to report each quarter what they think they're going to need as their bad debt expense and the allowance on a quarter-by-quarter basis. But then when they get to the end of the year and they prepare their year-end statements, that's when they stop and do an analysis of the balance sheet and determine if they have enough in the allowance. And if they've taken too much during the year, they take some out. If they haven't put enough in, they do what? They put some more in. That's the process, and I'm always fighting through textbooks that have this silly notion of you would either take the percentage of sales or just make an adjustment at the end of the year. Well, that's fine if you're not having to prepare quarterly statements and it doesn't matter that if sales are accruing, you're not taking any amount into the allowance. But if you were preparing quarterly statements, it would matter and you'd want to do some provision each quarter so that your quarterly statements aren't materially misstated. Okay, so and then would require an adjustment to be in compliance with generally accepted accounting principles. Okay, because auditors look at that, and auditors do. Excuse me, I got 4 minutes. Auditors look at that, and auditors do analytical procedures. And based on their analytical procedure, if an auditor determines that a material modification needs to be made in order for financial statements to be in accordance with the generally accepted accounting principles, they will call that out in their quarterly review report, and companies don't want that. So if you sat there and you took this percentage of sales each quarter, that would satisfy the auditors that you're at least taking some amount in the quarter. And then by the end of the year, there'd be an expectation that you do a financial statement analysis at the end to determine what needs to be in the allowance. Okay? So I think skip those questions. There's a couple that I put in that are very similar to the ones that we worked for the Chapter 7 practice quiz. And then for the Chapter 7 stuff, I would highly recommend that you go back through the quiz. In fact, I would recommend that for Monday you go back through the quiz for everything. Quiz for Chapter 5, quiz for Chapter 7, quiz for Chapter 8, quiz for Chapter 4, and this practice quiz as well, so that by Monday you're sitting there and you know what you know what you don't know, so that we're taking advantage of that extra time that we're going to have to Wednesday, right? Okay, guys. See you. Have a good, Have a good rest of the week. Pardon me?
So planted assets are gonna be on the
Huh? The planted assets?
Plant asset.
land assets, are they? Anyone?
It's an estimate. Just like the life of the asset is an estimate, the salvage value is an estimate. No, it'll be given in the file. A company would estimate, okay, I think at the end of 5 years, we should still have 2,000 left on this or something like that. We don't depreciate below the salvage value, right? Yeah. 24, 25, and 26, and 12. 12 times 2 is 24. Because I thought it was days in inventory, and it's not, it's some other. Yeah, I thought it was days in inventory, and that's why I put it on there. And then when I looked at it more carefully, this afternoon I was getting ready for class, I have no idea what they're asking me for. That's not days in inventory.
Days
I don't know what they're calculating as.
then it's allowance for doubtful. That's the same as allowance, right?
Yeah, I call it allowance for short. It's allowance for doubtful accounts is the correct title. Yes.
It's just so much easier to just stick all allowance.
Well, especially when we're in a hurry and I'm writing.
That
I have to sit there like
That's-
allowance for doubtful accounts every time.
Same reason it's or DDE.
Bad debt expense, exactly.
Still saying that over and over.
Right. Yeah. Remind me when you're leaving these midterm, then I'll remember, and then hopefully I'll remember and I'll go and I'll put it in. But we'll get it in there when we're in. Yeah. Okay, yeah.
Sure. Sorry, I still kind of don't understand about like the one you talked about. It's
So if you look and you take 1685 and you multiply that times 40%, that is not 685.
yeah.
That's that other number that I wrote there.
674.
Yes. Okay, yeah, I didn't realize I wrote it down there. Right. So it's 674, right?
Yes.
And they adjusted it to 685 here. But if it was 674, then if I take 674 off of 685, I get the new carrying value is 1,011, right?
Yes.
Okay, and then so if we went to another year, year 6, and we took 1,011, excuse me, times 40%, yeah, like you wrote there, that would give, did I put that there or you put that
I
there?
put that.
Okay, so that would give us depreciation of 404.40, right?
Yes.
So if you took 1685 minus 404.40, right, because we take this off of, we would have then depreciated below the salvage value. And you can't depreciate below the salvage value.
Okay, so our service value is 1,000. Right?
Yeah, right. So that next year we would have only taken $11 and we would have stopped.
Oh, okay.
The book just ignored the idea of taking the $11 in that last year.
Okay.
But the reason I go forward with that is it's like, well, now it's more clear that we didn't depreciate below salvage value. Because we were still short of the salvage value when we took the 40%, right? When you take that 40%, that next year is 404. No, we wouldn't take 404. Depreciation expense that next year is $11.
So it's in any kind of depreciation method, right?
Declining balance depreciation method, we're capped at the salvage value. We don't depreciate below salvage value.
For the units of activity and the straight line.
Well, we still don't depreciate below salvage value, but the way we protect against that is we don't use the salvage value in calculations. Whereas for declining balance, we don't use it, we don't use the salvage value in the calculations. But we put it off to the side and we keep an eye on that salvage value. We don't depreciate below salvage value.
So we just deduct it from first at the beginning, right?
For straight line and for units of production method, yes. But for declining balance, no, we don't take off the salvage value. So if you look, the calculation was being made here on the 12,000 when we made the calculations. Okay. When we came up with the amount per I don't know how to get your computer back up. The one before that. When we came up with the amount per mile, it was based off of 12,000. So we took the salvage value of $1,000 off for the calculations. When we did the straight line, we took the salvage value off of the original purchase value, divided that by 5 to get the annual depreciation. When we did declining balance, we didn't take off the $1,000. We just used the $13,000.
Oh, okay.
So that's why we have to keep that $1,000 on the side and make sure we don't depreciate below it. Yes.
Thank you.
Yeah.
And I have some questions too. Do you have like did you put the details like details answers like about chapter 8 please? Like all the calculations?
No. That's what class is for. But I'm gonna put this. I'm gonna post this. This recording, which I'm glad you said that because I want to stop this.